Right, everyone, warm welcome to Market Watch. I'm going to be breaking down what the hell's been going on in the market since Donald Trump started these trade tariffs. We've been seeing gold breaking to all-time highs. We're seeing the stock markets continue to decline. Trump keeps flip-flopping between what he's going to do and what he's not going to do. And there's a lot of uncertainty. The dollar's getting beaten up and sold off, which never usually happens during a stock market crash. And I'm going to show you some really good investments that you could make if the markets continue to slide lower, which is likely to happen because China's not backing down. And this video is going to add a lot of value if you're trying to navigate where to go. Okay, so what we need to understand, guys, okay, the stock markets have been going lower. Okay, the markets are losing faith in the US to uphold the law, the rule of law in the global financial order and the system. Okay, has been run by America since the 1940s, okay, since Bretton Woods. But Trump imposing all these tariffs unilaterally is actually breaking WTO's rules, okay, around trade. So Trump is criticizing countries for doing something, and then instead of him being the leader of the rule of law, he's going ahead and doing exactly the same. The markets don't like it, okay, because what are we seeing at this moment in time? We are seeing the stock markets, okay, if we just look at the S&P 500, which is the US equity market, we look at the NASDAQ, okay, they've been selling off. Why is the stock market selling off? Because the markets are predicting that a recession in America is coming. So what is a recession? It's simply 2 negative quarters of GDP growth. All you need to remember, GDP growth is simply the earnings and production of companies. So if the economy is contracting in GDP, then the earnings of companies are going lower. That's why, okay, earnings and GDP are linked. So investors are selling off equities in the stock markets, okay, and in the NASDAQ and in Europe and other stock markets because Trump's trade tariffs are going to mean imports into America are going to become more expensive for US consumers. Okay, so they're going to buy less goods and services. Now, America is the richest country in the world. $30 trillion economy, okay? They import around $3 trillion each year into their country of goods and services from the rest of the world. That means there's $3 trillion worth of currency going abroad, helping the rest of the world get richer as American consumers spend money. So the tariffs will mean prices for the importer goes up. So what are businesses going to do? Pass on those costs to consumers. So now consumers in America find they've got higher prices. What are they likely to do? Cut back on spending. Okay, what does that mean for the earnings of companies? It starts to decline. The economy starts to contract. That's why you've seen Goldman Sachs raising their recession forecast. I think it's like to 45%. So along those lines, here we go. People like Goldman Sachs raising their expectations for a recession to 45%. Okay, now what we need to learn about recessions throughout history, which will be very important for you guys when you watch this video. Recessions happen when there's 2 negative quarters of GDP. Remember, GDP is just the earnings of companies. So if companies' earnings are contracting, investors are dumping money out of the stock markets because remember, stocks only go up in value if companies can continuously grow their earnings because they're becoming more valuable. Whenever stock markets can't grow their earnings, they crash. Okay, it doesn't happen very often, it happens every 5 to 7 years, but it's a regular occurrence. But the markets do always recover. And I'm going to show you when they recover. And I'm going to show you why the market's getting nervous because Trump's tariffs are going to put the Fed in a difficult position because usually it's a central bank cutting interest rates that pushes up the markets. Okay, now let me show you. The last market crash and recession obviously was COVID 2020, right? When did the stock markets bottom? In March 2020. What did the Federal Reserve do in March 2020? They cut interest rates to 0. Okay, soon as the Fed cut interest rates, the stock markets took off. Notice the pattern, okay? Why? Soon as central banks cut interest rates, mortgages, credit cards, car loans, student debt, interest payments go lower. People can borrow money more freely. Investors buy stocks straight away because they know the earnings of companies will start to come back. Okay, that's why stock markets always bottom when central banks slash interest rates. That's 2020. Let's go back look at the last market crash and the last recession that happened in 2008/2009. Okay, look at the stock market crash, big sell-off during the financial crisis. When did the markets bottom? March '09. Okay, What happened in March '09? The central bank slashed interest rates to zero again at exactly the same time. Soon as central banks cut interest rates, markets take off. Okay? Then the dot-com bubble burst in the year 2000. Okay? Again, big market sell-off. Okay? The markets went down during that time around 50%. Notice the pattern, a 50% decline in the stock markets in 2000, a 57% decline in 2009, then you had a 35% decline in 2020. So these are the average stock market crashes, okay? But notice again, the stock market started to go higher around March '03. Okay, so towards the end of 2023, the end of 2022, going into 2023. Well, what happened around the end of 2022, going into 2023? Central banks were slashing interest rates. Okay, look, at the back end of 2022, rates were going down to the lowest levels, okay, 1.25%. And then in early 2023, they reached a bottom of 1%. So what happened again in the stock markets in early 2023 when a central bank started to slash rates? They take off. This is a pattern, okay? So all you have to understand, if the markets crash because earnings decline and there's a recession, the central bank cutting interest rates is always the trigger for markets to recover. But look what the Federal Reserve is saying. Fed Powell says strong labor market depends on price stability. So a central bank has a dual mandate, maximum employment and price stability. But Powell yesterday spoke and said to the markets, you're on your own because we cannot cut interest rates if these tariffs are going to create inflation, because the Federal Reserve is scared of runaway inflation. Now, what that means is if Trump's tariffs cause inflation, consumers may expect inflation to keep rising. And if their expectations for inflation over the longer period of time start to rise, this becomes a massive problem, because now consumers are going to demand higher wages by their employers, because they're going to say, if I don't work for you, if I'm working for you, pay me more money, I'll go work for someone else because I can't keep up with this inflation. Businesses are forced to raise prices to offset that cost of paying higher wages. That can cause inflation even more. Or the other scenario is consumers who expect prices to rise, they start quickly buying goods and services now before prices rise, exacerbating inflation even more. Okay? And you don't want to be a Turkey, Argentina with 100% inflation. Once that gets entrenched into the mindset of consumers, very difficult to change. So the central bank is saying, yes, usually we cut interest rates when there's a recession, but this time, how are you going to cut interest rates if there is inflation? Usually there's deflation when there's a recession. Prices fall because people stop spending money. But this time people are going to stop spending money potentially, right? Because they can't afford to. And you're going to have growth slowing at the same time, but inflation won't come down. It's actually going up because of the tariffs. So that's a fucking problem for the Federal Reserve. You may have high inflation because of the tariffs, and you may get hyperinflation that could rapidly get out of control if, again, consumers demand higher wages and, again, start spending money. So the Fed is trying to avoid the situation of letting inflation get out of control. And what they're basically saying is that the spike in inflation should be temporary, but they're not going to cut interest rates and make that inflation expectation maybe become more permanent. Okay, so the Fed is saying, I'm not coming to save the day. Maybe sending a warning to Trump to say, listen, be careful what you do. We ain't going to come and save your back. All right. Now, the markets don't like this because, as I showed you, every stock market crash ends when the central bank cuts interest rates. But the central banks said to the markets, you're on your own. It's called the Fed put. The Fed always protects the markets, right? But the Fed is basically saying, no, we're watching inflation. Okay. And we're going to allow inflation to spike because of the tariffs, then come down. And when inflation comes down, then we'll cut interest rates. We're not willing to cut interest rates when inflation is already higher because it could exacerbate the problem. So investors are coming out of stocks. Now remember, guys, stock markets go down 35 to 50% when there's a crash. Okay? Stock markets are only down 14%. So there could be some way to go. And we have to remember, if we look at the US economy, okay, we break down the key economic data. Sorry, it's got the camera in the way here. Look at what's happening already with inflation expectations. It's jumped from March being 4.9% over the next year to 6.7%. So again, what could consumers start to do? demanding higher wages, which could show up in the wage data. Okay, a big problem. We could see inflation starting to rise in the next couple of months, a big problem. So the Fed's very uncomfortable with what's going on. Now, remember, usually, yes, in COVID, the markets expected a big recession because the economy just completely got shut down. So the earnings of companies would obviously decline. So the market sunk. But the central bank cut interest rates aggressively straight away on the lockdowns, and the markets rebounded. So this didn't even last long. By the end of 2020, the markets were back up. Okay, but look and pay attention to what usually happens during a recession. The stock market's crashing in 2008 started in late October 07 and ended in March 09. That market was falling for 2 years. During the dot-com bubble, it started in August 2000 and ended in October 2002. That is a 2-year decline. So why would it take 2 years for the markets to go lower? And why you need to be very careful on thinking that the stock markets are going to rebound, because the reason stock markets, will recover, the reason stock markets take long to decline is because we're humans. We really do hope there's not going to be a recession. But each and every month, the data starts to get more and more negative. There's more and more selling. But we're humans. We hope the data is going to be positive. So again, we're waiting for next month's data and maybe the manufacturing PMI data, which tells you the earnings expectations of manufacturing, makes up 20% of companies. If that keeps going beneath 50 and gets worse and worse and worse, then there's more and more selling. If the services PMI, which again tells you the spending in the services sector, makes up 80% of businesses in America, if that slips beneath 50 and keeps getting worse and worse and worse, more and more selling. But remember, we're humans, we're hoping the next month will be better. But the more it deteriorates, the more the stock market sells off. But that's why it takes a longer period of time to happen. And then consumer confidence. What drives spending? Confidence. The consumer confidence right now is at 57. That is indicating a 3% level of GDP, minus 3%. That's a recessionary environment. This is the lowest level since the 1940s. People don't like what Trump's doing. So the more the data comes out month by month, the more the markets get scared, the more the markets sell, and then the Fed starts to cut rates. But remember, the Fed's also hoping that the data will improve. And that's why stock markets take longer periods of time to decline. So this could only be the beginning. If the data keeps getting worse, if Trump keeps amplifying his trade war with China, don't expect the sell-off to stop. It's going to continue. And with Jerome Powell saying to the markets, we're focused on inflation more than economic growth and the unemployment rate, the markets are not liking it. So what are they doing? Markets are now seeking safety and they're exiting the stock markets. Where are they going? They're putting their money into gold. Now, gold was a trade that I took with the members because gold is a safe haven. Okay. Again, driving up haven demand. Now, China is the second biggest holder of US government bonds. Look, who owns most US government debt? It's China. Japan's first, China's second. Look, China is the second country behind Japan to own the most US government bonds. What is China now doing? China doesn't like this game, that the US is playing with them, blocking them with technology, ramping up tariffs to 150%. So Chinese bondholders are dumping US treasuries and buying gold, This is what they're doing. This is how they're going to force America to try to back off. Because the reason Trump turned around recently and said to the markets, I'm going to end this huge tariff and I'm only going to punish China, but I'm not going to punish the rest of the world. Everyone only has a 10% tariff, is because the Chinese and other countries started selling off US government bonds. And you saw government bonds on a 30-year and the 10-year going up aggressively. Now, why is this a problem? Mortgage rates in America are pegged to the 30-year. Look how high they are. They're now at the highest levels, in quite a long time, 5%. And if China keeps dumping these bonds, to punish America, saying, we don't want your fucking bonds, the interest rates go up in America. And remember, America has a big debt problem. So look, China, it's all over the news, dumping US gov bonds, They're waiting for the data to come out. Okay, so look, they're talking about, is it China that's been dumping the bonds? But what they do know is that international investors are selling their bonds. I'm going to show you the next article. So China's selling bonds, okay, and everyone's buying gold. That's why gold is flying through the roof. Now, all you need to understand, guys, gold is a store of value. It's been that way for thousands of years. Gold in 2025 is already up 28%. Last year, gold went up, I think, 28% in the whole entire year. So think how much having demand is going into gold. So look, gold last year was up around 30%. It's already up 30% in 4 months. Okay, now notice, look what all the investment banks are suggesting. Okay, because of this trade war. Gold just broke $3,300 an ounce. Goldman Sachs are saying gold's going to hit $4,000 an ounce. And the reason behind that is because the US dollar's weakness, the investors are selling US dollars and it's hurting US assets because people are questioning the legitimacy of what Trump's doing. Dollar linked to US Treasury weakens as confidence cracks. Investors are looking at America saying, are you really the leader of the world? Are you the responsible leader? His hostility, Trump, towards the rest of the world, markets don't like it. So they're selling US government bonds. Usually this is the safest place to park your money. So usually during every crash, the dollar gets stronger. Okay, but look what's happening. It's delinking. Okay, you're seeing bond yields going up because investors are selling US assets. They're selling stocks. And usually they'd buy government bonds, but look what's happening. The dollar is getting weaker. The yen's getting stronger. The euro is getting stronger. Even the pound is getting stronger against the dollar. Usually, guys, look what happens during every market crash. 2020, the dollar went up 12% against the pound. Let's go back to 2008. The dollar went up in value by 32% during that crash. In 2000, 16%. Look at the euro. Lost 22% of its value during 2008. Okay. During the 2000 dot-com bubble, the euro slumped against the dollar. Huge, 30% moves. COVID, it lost 7%. But look what's happening now. Markets are crashing. The euro's going up. This is a problem. Investors are not liking America. They're dumping US government bonds. They're dumping US stocks. And they're moving away because confidence is being cracked in America. Okay? So dollar fears grow as traders increase hedges to 5-year highs. They're hedging against more dollar selling. Okay? End of America first trade, boosting European markets. Europeans' long sluggish financial markets are being shocked into life as Donald Trump's drive to reshape global trade and security undermines America's decade-long dominance. So what are they doing? They're jumping into European assets. They're buying European bonds, which would never really get the demand, but now they are. Okay. The euro is seen as strongest in 3 years. German bonds, last week beat treasuries, US treasuries, by the most ever. So we're seeing the euro going up in value against the dollar. And the more Trump is hostile, the more Trump is being arrogant to the world, the more they're betting on a stronger euro. Okay, so they're talking about euro USD going up, I think, to 120. They're predicting. If you look at the currency moves, where can I get the articles I was reading? Upside analysts are saying euro USD to 120 forecast. Let's see if we can find it. Here you go, look, Goldman Sachs now bet on euro USDs go to 120. Listen to what they're saying. BOG may mule hiking interest rates if yen nears 130. The yen nearing 130, do you know what that means? And this is why I just sold the yen against the dollar. As you can clearly see over here, my members, we literally just sold dollar yen. Okay, look, 400 members trading with me. We just sold dollar yen. Okay, our gold trader in big profits as well. We literally bought gold the other day as well. So members are making money with me on these trades. Okay, these are typical recessionary trades. Okay, we're taking advantage of the safe haven gold, and the yen does strengthen against the dollar. But look what they're saying for the yen. Okay, the yen to strengthen against the dollar to 130. That's another 10% move. Okay, so they're all betting on more dollar weakness. Why? Again, they don't like what America's doing. Okay, so Donald Trump is damaging America's reputation badly. Okay, Goldman Sachs are raising their recession forecast. Okay, so this is a big problem. So what we need to remember is usually the central bank is going to cut interest rates to save the day. So now you know if the economic data continues to deteriorate, what's going to happen? The stock market is going to keep selling off. When does the stock market bottom happen? Either there's massive trade deals being agreed, it doesn't look like that's going to happen right now, or the central bank slashes interest rates. So we have to wait for the Fed to cut interest rates before we can have the confidence that the markets can recover. The markets are betting on 1, 2, 3 rate cuts this year, but the Fed's pushing back saying, nope. Okay, and this is going to change this outlook. So the Fed, this is a really good analysis we can look at. Each meeting, where are the markets pricing the Federal Reserve's interest rate to go? The markets were betting on rate cuts, but the Fed yesterday just dashed cold water on that. Okay, so what are the markets doing? They're buying gold. That's the best way to play this. If you've got a stocks and shares ISA account, if you want to buy ETFs and not have to worry about stop loss levels, look what these ETFs you can buy. Okay, gold mining ETFs, number 1. Number 2, gold mining ETFs. This is on Morningstar, the top ETFs in 2025. The third one, gold producers. The fourth one, gold. International investors are dumping money in gold. Guys, what do you need to put your money into? Gold. That's it. And I'm going to teach you something which is going to be beautiful now when you see gold. So gold's being boosted by everyone selling US government bonds, putting money into the safe haven gold. But look what's really interesting. Remember I showed you in 2020? So usually, look, every time the stock markets crash during a recession, gold usually goes down as well because investors in the stock markets have to liquidate gold to pay for margin calls because they get knocked out of their stock positions. Look, so in 2020, stock markets dropped, gold dropped 14%. When stock markets went up, so did gold, okay? Go back to the 2008 financial crash. Look, no surprise, gold went down with the stock markets and they both bottomed at the same time. Why? When the central bank cut interest rates. Okay, same thing happened in 2000. Okay, gold went down by 25% when the stock markets had that 50% decline. So usually when gold gets hit with stock markets, when they both crash, because investors have to sell their gold to pay off all this losses in their stock market portfolios, right? But look what's happening now. There's a delinking between what's happening. Gold's going up, as stock markets are coming down. So what does that show you? If the stock markets keep crashing, gold keeps going up. And historically, soon as central banks slash interest rates, gold goes up even more. So gold is going to fucking fly. Okay? And what's beautiful about this is you just have to understand, why do investors buy gold? You buy gold as a protection against inflation. What is Trump's tariffs going to do? Create inflation. So you want to buy gold to hedge that inflation because you can't buy stocks because they're falling in value. Okay? Because of the trade war. Now, the reason you buy gold is because if interest rates on government bonds start to go lower, usually when central banks cut interest rates, why would you want to buy government bonds, which are now going to pay less interest at a time when central banks cut interest rates, which means they're increasing the money supply to try to create inflation and economic growth. So those interest payments are losing their purchasing power to inflation. So usually that's why as soon as central banks cut interest rates, gold flies, because investors don't want to be buying government bonds because the interest rates are going to be going down and they want protection from inflation. So they buy gold. Okay. And you noticed a very good relationship between when central banks obviously raise interest rates, which you could see here in 2022 to fight off inflation. The central bank really started to raise interest rates aggressively from March 2022. You can see interest rates went up and look what happened in March 2022. So this is a really good education for you guys to understand interest rates. Look what happened over here with interest rates on a 10-year, and let's look what happened to the price of gold. So when the Fed was raising rates in 2022 aggressively from here, as the Fed was raising rates, look what happened to gold. Gold was going down, right? But remember what the Fed's saying. They're not raising rates right now. They're just not going to cut rates. Why would gold go down when rates go up? Well, think about it. You're decreasing the money supply by raising interest rates. So now there's going to be deflation in prices. So prices are going to go down, but interest payments on bonds are going to be going up And the purchasing power of that money being paid to you from bonds is going to be increasing because there's a deflation in prices. But again, now you know and you understand it. Soon as central banks start slashing rates, as they did last year, 4 times, and if the markets predict rate cuts, then they buy gold, as I said, as a hedge against inflation. So we are in the sweetest position right now, guys. Stock markets keep falling. Investors keep dumping government bonds in America, selling the dollar, buying gold as a hedge, pushing up the price of gold. And then when the central bank slashes interest rates, as they do every time the markets have a deep recession, and they're telling the market they're not going to cut interest rates, okay, and you're all on your own because they're telling you, look what it says, central banks have a mandate, maximum employment and steady inflation, but strong labor market depends on price stability. So they're saying we need to make sure that prices don't go out of control to save the labor market. So if the labor market starts to see higher unemployment because of what Trump's doing, the central bank is saying we're not going to save the labor market because price stability is the most important thing. So there you go. These rate cuts ain't going to come until we have inflation coming lower. And then when inflation does come lower and the central bank cuts interest rates, bingo, gold goes up even more. So you got two. It looks like gold's a win-win right now. Okay. And that's why all the investors around the world are buying up these shares. Look how much this ticker has gone up. This is an ETF that you guys can buy. This is what I've been doing with all the investors that I help with their stocks and shares ISA. Look at this, guys. So look, gold's up 30%. This thing this year already in 2025, 60%, 50%. So while the world, everyone's losing money in their portfolios, if you know what you're doing, guys, your money will be up 60%. You double your money basically. And remember, this is the first quarter of the year. So if gold has gone up 30%, if gold has gone up by 30% at the beginning of the year, and we're only 3 months into the year, Goldman Sachs are predicting it to go to 4,000, which means there's another 20% move to go. How high will this go? This is up 50% when the markets are only up 28%, and we're betting on another 20% move. This could be another 50%. So your money could double. Guys, knowing what to do is so important. Okay, don't be ignorant and just have your money sitting in the bank. Because remember, if inflation's coming, what's happening to the purchasing power of your paper money? It's declining. There's deflation. That's why we are buying gold. Me and the members are making some amazing money. The group chats are going off. Everyone's buzzing, making money. Okay, you need to start learning about the markets. This is why fundamentals is crucial. And to be able to time the markets and know when these rate cuts are coming, you have to have the data to know when the markets are betting on the rate cuts, what's the key economic data to look at, and you have to stay on top of the news. All right, this is why so many people who try to trade technical analysis just never make money because you don't know what's going on. You have no idea what's driving price. Okay, so if you guys really want some education, I got 500 course members that I'm educating. Come on board and learn. Okay, all you got to do is click the link below this video and you can speak to my team about potentially coming on board and getting educated because it will transform your trading and you'll get incredible results. Just watch the testimonials. You'll see members joining my group and turning 1,000 into 12,000 in 4 weeks, turning 5 grand into 25K in 6 months. Okay, depending on how much risk you want to take, but the proof's in the pudding. I'm doing it myself and you can do it as well. So guys, I'd love to hear from you guys. What are you guys trading? What's your views on the markets? I would love to be able to share with you guys what I'm doing and hear from you guys. So come into my free Telegram channel. Got thousands of people in there. I'm just giving away free education every day. It will definitely help you stay on top of the markets. And I'd love to potentially then start investing with you at some point. Okay, guys, so what we're looking at, a weaker dollar. Remember, the betting on downside for USD JPY. We're betting on upside for Euro USD. If the trade war intensified, gold's going up. Stocks are going down, so you can sell stocks, buy gold. And then we're waiting for the Fed to cut rates because that's going to be the floor. That pushes markets higher. And we have to look at the economic data each month to know if it starts to deteriorate because we could get a big long sell-off like in 2008 or the year 2000, okay? Because you have to understand history. Right, guys, thank you for watching. I really hope this video did add some value to you in your trading. And let's see what happens.